Okay,
Yes,
thanks, Charlie, for a good talk with Cynthia this morning. Good morning also from my side, and welcome to day 2 of Paris Blockchain Week Summit. My name is Hansjoerg Hettich. I'm the Executive Director of MAMA, the Multi-Chain Asset Managers Association, and we are a non-profit association and a member community spearheading the vision of blockchain asset management and on-chain asset management. Check out mama.global for more details, or DM me on the chat later after the panel. So coming to the panel, one key element of markets, be it the traditional markets or the crypto markets, is indeed liquidity. And we are discussing the state of digital assets liquidity today. And I'm very thrilled to have a great panel today looking from very different angles towards liquidity. We have a decentralized exchange on the panel, we have centralized exchanges on the panel, and we have a market maker to speak about liquidity. So let's kick that off. And with a quick intro round, maybe Will, you represent the decentralized exchange world. Maybe you start with a quick intro.
Absolutely. So I'm Will. I'm the CEO of DeversiFi, and we're a team that's built a highly scalable and fast decentralized exchange. It's built on the Starkware Layer 2 scaling system on Ethereum, which allows us to have any Ethereum asset and trade them very quickly with a look and feel of a centralized exchange. Our mission is really to bring aggregated liquidity from multiple centralized exchanges directly to traders who want to access either from their own personal wallet, so you can connect with MetaMask, Ledger, and others, or from a custody solution. And so our kind of liquidity thesis really is that liquidity is moving from being about going to one venue where you can access liquidity for an asset to accessing it directly from your own personal wallet that you can control, or any location that you choose, and really kind of taking liquidity to you rather than the other way around.
Yeah, great. Thanks, Will. Moving on to the centralized exchange world, Lev, over to you. We just lost him, so we jump over to Peter, also from a centralized exchange view.
You're in mute.
You're still on mute, Peter?
Yep.
Still on mute. Maybe we continue with you, Charlie. Obviously,
yes.
You are looking at liquidity, or you probably are a liquidity bringer and provider as a market maker. Do a quick intro, please.
Yes, so we do market making on exchange for 3 years now. We are a French market making firm backed by 2 institutionals, and we basically make markets directly on exchange, but as well through our single dealer platform, where we provide liquidity off exchange. So we see the inflow, the outflow when it happens on exchange, and we help exchange build their liquidity by posting constantly orders on order books.
Nice. Peter, are you on now?
I hope so.
Still on mute. Maybe
it's
in the
better,
meantime,
yeah.
Before we look at the state of digital asset liquidity and where we are now and what has changed over the last 2 or 3 years, maybe let's just quickly talk about the definition of liquidity. What is it, what we mean when we talk about liquidity? I guess it's so much more than just a market cap and volumes. Maybe Will or Charlie, you can give a more broad definition of what you think about liquidity. What is liquidity?
Well, I can start with by saying that when we talk about any asset, when we talk about its price, we talk about its mid price. And then if you really want to know how easy it is to buy it or sell it, you will have to look at what spreads can you get to be able to buy and sell constantly 24/7, or when markets are open. That's the job of a market maker. Defining the mid, and then defining how close to the mid I can be when I sell or when I buy to counterparties. A very good market maker will quote very close to the mid, and a prudent and a wise market maker, very wise market maker will distance with it and be wider. And when the asset is very, very liquid, it's of course easier to stay very close to the mid. When we're talking about an asset that has no liquidity depths, where it's very difficult to hedge, where it's very difficult to find counterparties in instant way, you will take your distance from the mid. And that's how you can define liquidity. How close to the mid you can be for how much.
Yeah, so it's also the ease of exchange of two assets, be it fiat crypto or crypto pairs, obviously, and also in the traditional world, the ease of exchange of two different assets. And you mentioned it, the cost, the spread to the mid price, obviously, as well. And I guess also the transparency of what's going on an exchange is certainly an important point. Yeah, maybe then not looking at the centralized exchanges for now, right, diving into the decentralized worlds. Will, where is your liquidity coming from? I mean, I guess on the decentralized side, we still see very, very low volumes compared to centralized exchanges. But still, where is it coming from, and what are your key points when it comes to liquidity?
So I think this year we've seen the kind of biggest growth so far in decentralized exchange liquidity. And that's kind of constantly for the last few years, as there's been many prototypes of ways of providing liquidity and trading in a sort of decentralized manner, often without custody risk. The biggest problem has always been liquidity, and that's starting to change, but it's still in the early stage. In the case of DeversiFi, we have sort of two approaches. One is actually by aggregating liquidity from centralized exchanges, and that helps really as a kind of a bootstrapping mode to help mean that if someone comes and trades from their MetaMask on DeversiFi, actually they can see the same order book and the same prices that they might see if they're using one of the top centralized exchanges. And so they're guaranteed to get the same price with minimal slippage. And that's done actually because sort of our team sort of helps market make and bring those prices across. But also you can provide liquidity directly, and anyone who has any funds in their wallet can do that. And that's, I think, what we're seeing really help now is a shift over from being sort of professional market makers providing liquidity to actually exchanges and decentralized protocols providing the tools for anyone who has assets to very cheaply and quickly and easily provide liquidity without needing to then maintain it and without needing to run complex software and run that on some servers that they've set up. And that's a huge shift, I think, that's kind of happened and really been demonstrated how powerful it can be in this summer in particular, because suddenly you do have very significant liquidity, often comparable on lots of assets with the top centralized exchanges for some tokens. But that's in lots of cases not provided by professional market makers, but just by large holders of those tokens who've deposited them and used automated market makers or other methods to be participating in the market. And I think that's one of the most interesting shifts in liquidity.
Yeah, thanks, Will. Certainly, definitely a great big shift. I fully agree on that one. So let's try again to have a look at the centralized exchanges. Let's start with a quick intro. Lev, hope we can hear you now.
Yeah, can you hear me now? Got some, yeah, I do. Got some issue here with the internet. First of all, I have nothing to do with centralized exchanges outside of our company. Probably trades about $50 to $100 million a day on those exchanges. I represent a company called Quantfury. I'm a chairman and a founder. It's rather to be a centralized brokerage that lets people around the world have their account settlements to be done in crypto, but they trade various financial assets and nominal value of those assets, be it dollar problem if they trade cryptocurrencies, or US dollars if they trade the financial assets traded in United States markets such as futures or stocks, or euro if it's European stocks. So sorry, what was the question? So it's like 4 o'clock in the morning. So I'm
sorry.
The question was
first of all the quick intro, and
so we're not centralized exchange. Yeah,
I come back to you very shortly. But Peter, maybe you can give the intro on Bitpanda and also talk about where your liquidity is actually coming from as a centralized exchange.
Yeah, thanks for that. So sorry also for my connection problems. I'm Peter, I'm the CFO of Bitpanda, which is the biggest European-based crypto brokerage. We also offer precious metals, tokenized precious metals. So we have actually two products. The one is our classical brokerage business, where we actually also, in terms of liquidity, that's probably the topic for today in this regards, we actually provide the liquidity ourselves. Yeah? And on the exchange, which is our second product, Charlie knows us in this regard. So we are, of course, use our own funds, but as well as market makers as a centralized exchange. So quite typically, the typical model, how we provide services to our customers. And of course, market making as well is a very important point, as it provides a very good customer experience in terms of having permanent updated prices for the customers. Yeah.
Yeah.
So if I may, so if you just made to add the question, I know I get the question now from what Peter said. So, Quantfury, actually, we are not market making anything. We deliver the exact prices of relevant exchanges for those financial assets. So users can have an exposure without any fees and they can just trade those assets. We only use our own liquidity to kind of hedge the user positions, but also we have also asset management of our own kind of a spec positions in cryptocurrency market, and we use our own funds or funds that we raise from our shareholders and in the market in general.
Yeah. Thanks. And Charlie, on the market maker side, obviously you're providing the liquidity. Where do you get it from? Is it more the relationship with obviously your clients, or is it more, let's say, tech driven? How would you define the daily work of a market maker?
Well, being a market maker is a job that has been existing for years and years, for decades, since finance exists, actually. For any assets, you always have people that show what we call risk price, meaning price that is what you can get from your asset if you're selling them, or for how much you can source them, and you need a counterparty to do so, and market maker is the person that is always taking this risk for you by showing a price. And for most of the assets, it's a really financial challenge, because you will be trading on maybe 4 exchanges, which will be Euronext and New York Stock Exchange, and the same in Asia. But with crypto, you have so many exchanges, you have so many solutions. All of them are different. Will is proposing an amazing product that is challenging all the centralized player. You have Peter that is proposing a product where you have so many users coming in the same time. Lev is proposing again something else. The liquidity is very fragmented, so it becomes a tech challenge for player like us, because we have to integrate all of them to be able to show the best price at any time to our counterparty. And if we miss anywhere where there is a lot of liquidity, it means our pricing will not reflect what's happening in the market, and then we will not be doing a good job. So the challenge is definitely a tech challenge. If you look at our lines of expense and over a year, it's only on the tech side, on building our infrastructure, on maintaining our infrastructure, on recruiting tech talent to be able to upgrade it on a monthly basis. If we do not code for a week, we are late. Our pricing will not be good enough anymore. So yeah, it's definitely a tech challenge.
Yeah. I wanted to follow up on the previous point Will made. Obviously, liquidity has been impacted also by the DeFi summer in 2020, and when we look back to December 2017, the overall market cap was above 500 billion. Now we are back again above 500 billion. What has changed on the liquidity side of things? So what are the true innovations there, and how do you see that going into the future as well? And that's obviously a question to all of you from your different views and angles onto liquidity.
I think, let me start perhaps in this regards. I think generally, when it comes to liquidity and the cryptocurrency market, I see the major change that previously it was more kind of a hype thing. Today, I think it's more even if the technology itself has not fully deployed and not fully realized its potential, so all the smart contracts, etc. We are still far away from having all those potential implemented. But I think what actually changed is the trust of people. No? So what we also see, the bounce back down to very low market prices didn't happen. So what I basically see is a trust change. So that cryptocurrencies, BTC, ETH, etc., just are perceived differently today. So it's open to a broader market. People perceive it differently. That's actually what I see. Also, what was very interesting at this year, it's actually was first the market prices went down, and so actually like the stock market. So it was very interesting to look at that. But the recent move was completely decoupled from the general markets. So that was also very interesting. So it was, and what actually defines a mature market? It is the ability to decouple from other markets. And this is actually what I perceived as being very interesting.
So if we go based on the age, maybe I should be like second, I guess, right? So actually, it's a very interesting question. I don't really see, trying not to have a kind of optimistic or pessimistic view, but rather maybe objective. So if we have 2 or 3 years ago, so first of all, the whole liquidity of the market today is basically retail, right? So this is the retail, it's kind of the margin accounts, and there's a different discussion, how does margin accounts used by whom and how. But 3 years ago, the premise was that there will be going to be a software revolution. The blockchain is a kind of a infrastructure software framework, and you got a lot of services and there's tokens and coins, and the Bitcoin will be a great vehicle to exchange value. And so that narrative changed. That we don't have really a lot of examples of great technology. Well, probably there are, but not in daily use. You don't see Bitcoin as an exchange of value in Starbucks and so on. So now we have this rather, I would say, quite dangerous narrative that the crypto will be the safe haven, versus irresponsible fiscal policies of G7, and it will save people from the collapse of the world. Therefore, everybody has to buy Bitcoin and hold it, which is to me it's kind of problematic for future liquidity. But there will be a lot of people with the margin accounts and exchanges, and those exchanges will use it for other poisonous products that will create a little bit more activity. But I don't really see that many changes. It's just a reason of why people being sucked in. But I got to tell you that the guys who are doing the market making or working with that liquidity for whatever reason, they are much more sophisticated those days.
Well, if I can just add something. For years, we've been trying to develop our business with the incumbents such as Bitpanda, such as all the very liquid exchanges where we have been deploying capital and growing, now trading dozen millions a day on the Euro market. But people like Will has been challenging us on a daily basis, and we had to develop to adapt our infrastructure to be able to connect to decentralized exchange as well. So we can announce, for instance, that we will deploying capital on Dexter, which is a Uniswap-like exchange on the Tezos protocol, and that's why it takes for player like us to be on top and to keep growing and catching more liquidity.
So maybe elaborate a little bit more again about the DeFi summer and the automated market makers, the liquidity providers, the liquidity miners, and all that true innovation which came true over the last couple of months.
Yeah, so I think the overall picture that we just had is very much that the market's become more sophisticated. There are a lot of sophisticated market makers and other players in the space, and in general, liquidity that's good for liquidity, and liquidity has become potentially better than it was 3 years ago across multiple exchange venues, and it's easier for retail in particular to get good prices as a result of that, and to trade with potentially more leverage. And I think leverage has become more common, and so there's better capital efficiency for most traders. But what we've seen in the kind of smaller starting bubble of decentralized finance in that period, I think has been even more explosive and even more it has changed even more. I think it's less been about sophisticated players, but more about protocol design and this idea of composability and interoperability, which maybe I'll just elaborate on here in that one of the sort of biggest changes, I think, has been that interconnectivity, which has usually been done between multiple exchange venues by professional market makers who have to deploy capital at multiple venues and then arbitrage between them, is almost done as a kind of native building block of this stuff. And it started off very small with a few different decentralized exchanges that didn't have any liquidity. And particularly, I think a key point that was made just now is that they were, essentially the prices were always following other venues, and that they were following the centralized exchanges and usually had slightly worse prices that people would arbitrage to kind of keep up to date with whatever the prices were as they were moving faster elsewhere. But one of the sort of biggest changes I think we've seen is that in some cases, particularly for a lot of the kind of newer assets, prices are really being led by decentralized venues now, and that's because they have more liquidity and because it's easier to provide liquidity to those places. And so if you want to bootstrap a market, actually to start with, it's hard to know whether there's going to be much trading volume, whether there's going to be many fees generated. And so there's a high cost of capital to a market maker to deploy, especially a professional market maker who knows they can make profit elsewhere, to deploy funds to provide liquidity for that asset. But for someone who may not be a professional market maker but has lots of assets that they're speculating on and want to hold anyway, the cost of capital is much lower so essentially the opportunity cost is much lower to provide liquidity to a decentralized exchange protocol or to a decentralized exchange if they're essentially not having to do any work to do it. And so what we've seen is for bootstrapping markets, automated market makers have been kind of a transformative tool. I think as those markets grow, there's still a huge play. There's obviously an important role for order books and for professional market makers to play. But in terms of the simplicity and ease of kickstarting liquid markets, the tools that are arriving in DeFi have already proven themselves to have a kind of permanent place. And the question now is whether that will translate to the kind of biggest, most liquid markets, ETH USDT, Bitcoin USDT, etc., where I think the battleground is still more uncertain. But for smaller long tail assets, it's kind of already, I think most especially retail traders in the market know that if they want to get a good price, they're probably not going to go first of all to a centralized exchange, especially on very new markets. They're going to go to a decentralized exchange. Particularly Uniswap has now kind of real sort of mind share for those kinds of assets. And DeversiFi as well is starting to now roll out many more tokens very fast with good liquidity. And that's, I think, quite a big shift from where 2 or 3 years ago you'd always go to a centralized exchange to get the hot new assets. So yeah, I think that's definitely a sort of chasmic shift.
So we only have 3 minutes left. One topic where liquidity is also often discussed and is kind of a promise is on the tokenization side. When we say we tokenize real assets, the promise is always that we make an illiquid asset more liquid. What is your view on that one? Is that a true promise automatically?
I mean, actually, I think we made the example as a company where, as we tokenized gold or precious metals, so to say, so we have currently gold, silver, platinum, palladium on it. So it's a real physical asset, which is stored in real vaults in Swiss and Germany. So I think it can definitely work, but I think we should also be realistic in terms of an already really illiquid asset. Yeah, so where people are basically not interested. I think new technology can do a lot, and tokenization can do a lot. Of course, it lowers the barriers. It makes it, you can buy fractions. However, It's unrealistic to believe that a fully illiquid asset automatically gets liquid and there is a big market to it just by offering it. Yeah, so we have to be cautious on that, of course. Yeah.
Yeah, sure.
I mean, if it's a liquid, it's probably there is a reason why it's a liquid, you know. But you know, it's a good question actually. A lot of people kind of like look at gold and they think it's a liquid, but gold is being one of the most coveted metals in the industry. It's used in multiple industries. It has a great qualities as a metal, so there's a lot of demand for physical gold. I think again, you can actually share if there's a big asset and you want to share it. So that's the conversation idea. It's pretty good, but I don't think today it's quite popular. Maybe 3 years ago it was the idea to use it and share it with people and do it transparently. But I just really want to bring again back to the fundamental idea of assets and being digital or not, and liquidity behind it. You need to have a certain transactional value behind them. People need to use them, and if they use them to leverage them again and again, even if it's a DeFi, you need to look at an underlying product. If the underlying product is greed, then somebody's going to lose or somebody's going to win, and the ongoing kind of every party will compete with each other. Nothing will happen at the end of the day. You're going to have a Facebook and Google and nobody else, which is pretty much like what's happening there in the crypto space. We'll have a 10 market makers for slash exchange owners, but in essence, as long as more people own today illiquid assets such as cryptocurrencies, we only can wish that something good will come out of it. Because you still have a security, you have still independence, you still have a lot of pluses, and at the end of the day, I'm sorry, just one thought to the end. Pretty much what exchange today, what cryptocurrencies succeeded is really make banks kind of illiquid potentially. So that's a good thing.
That's a good and a nice point to end on the panel. So thanks to you all. Thanks Charlie. Thanks Will, Lev, and Peter.
Thank you guys.
Thank you to all of you. Have a great day at BWS. Bye bye.
Thank you.
Bye.
Thank you. Bye.